Joining us now is one investor who actually raised red flags around SVB before the collapse, much like Eisman did so many years ago. Bill Martin, founder of the family office Raging Capital Ventures, and he joins us now. Bill, welcome. Good to have you with us. What did you see? When did you see it? And how?
Well, I followed the company closely for some time. What really intrigued me last year was the issues that venture companies were having. And I was concerned that that would translate into credit losses on their venture loan portfolio. And as I started digging in, what I soon learned, however, though, was that they had bought a significant amount of long duration, low interest rate mortgages at the peak of the market in 2021. And we're facing a significant hole around that. And I shared that with my Twitter followers in late January.
So it was really the question of where they were deploying some of the excess cash that they had. It was in those long-dated mortgage-backed securities and treasuries, and the losses, the unrealized losses on them, were blowing a hole in their balance sheet.
Yeah, correct. I mean, we had a venture bubble, and literally $100 billion plus flowed into Silicon Valley Bank over about an 18-month time frame. And they needed to put the money somewhere, and we'd had low interest rates for so long. I think management got greedy and complacent, and they bought long duration, low interest rate mortgages, which was kind of the wrong thing to do at that time.
I have kind of a basic question, Bill. Why didn't they get out of those positions? In other words, once they bought them, were they stuck? Because when they started to experience losses, if they didn't, I don't know if they could sell them. I don't know exactly how it would have worked against the size of the banks and so forth. But they would have realized one way or the other, they had to avoid realizing the losses. Is that basically right?
Yeah, I mean, on one hand, the change in interest rates over the last year was so rapid that I think it caught a lot of folks flat-footed. And Silicon Valley Bank, while an extreme example, is just one of many banks that's sitting with mortgages and loans at below market interest rates. But in their particular instance, they chose to hold a lot of those mortgages in the held to maturity category of their balance sheet, which is an accounting machination which allows them to avoid running those near-term mark-to-market losses through their balance sheet and their book value. Right.
Bill, the most important question for people now, and again, major hat tip, I don't know if there's going to be a movie, but obviously you've got a starring role here. Are their next shoes to fall? Because when I look back through your analysis and the way you've described it, it feels a little bit like this was an obvious problem out there. But I'd like to know now, based on the deposit flight that we're seeing, if you would screen other banks as being in kind of similarly vulnerable positions, or if you think this was idiosyncratic.
Yeah, great question. I mean, obviously the markets are nervous, and we're seeing every single day the news flow, and the psychology is stressed at the moment. There are a lot of banks that have these type of loans and mortgages, but not in the significant position that Silicon Valley Bank had. So. I think for the industry as a whole, a lot of banks face a period of de-risking, having to raise equity capital, which ultimately just translates into lower earnings and lower profits, but not, kind of the type of events we've seen over the last week.
What do you think explains the error that was made here? Was it taking the eye off the ball? Was it a rookie mistake? Was it hubris? What?
Great question. I mean, you did have a 5 or 10 year period where rates were very low, and I think management got greedy and complacent. On top of that, investors weren't asking the tough questions. Sell side analysts weren't asking the tough questions. And you actually look at the top 3 holders; they're all passive holders, so they were focused on other, initiatives, not necessarily going through filings and digging into the numbers.
There must be so many other shorts or investors or hedge funds, Bill, who are kicking themselves and saying, you literally tweeted about this. Are the markets really efficient? I don't know. I mean, we had Martin Gruenberg warning about this problem. We had people starting to tally the size of the losses across the banking system. You've singled out the player most at risk, and yet nothing happened. I mean, are you aware? Are there any other players who made big gains on this one, or were you kind of out there all by yourself?
Being a short seller can be a lonely business at times. And, ironically, for all the kudos on the great call, I was down a quick 20% in late January.
Sure.
When management came out and said everything was hunky-dory. So, it's never easy. And, I never could have foreseen it playing out quite like this, right? I think the good news is, a lot of folks I knew on the West Coast were able to avoid the issue directly and kind of make backup plans. And I know of some other investors who did capitalize on it. Yes.
How did your short play out? You make a lot of money?
Well, ironically, I had puts for February that expired worthless. You know, I thought management was going to have to come clean at the end of January when they reported earnings, and they kicked the can. So I had a large individual short position. I did cover a chunk of that in that wild trading last Thursday, and then I'm still short some, which is at the moment frozen for trading. So we'll see how that plays out.
Wow.
All right, Bill, thank you very much. Good to hear from someone who has been in the stock and it has clearly done the homework.